Very good afternoon, all the dignitaries and participants for today's panel discussion on recent landmark judgments in direct taxes. We have our esteemed experts with us, our chair and other esteemed guests. So we invite our chair, Shri Anil K. Chopra ji, Chair Direct Taxes Committee on the dais, and Ms. Gauri Puri, Shardul Amarchand Mangaldas, Mr. Harpreet Ajmani, EZB Partners, Mr. Rohit Jain, Vash from Vash Associates, and Mr. Gaurav Jain, Advocate, and Mr. S.R. Patnaik, Sril Amarchand Mangaldas. So we welcome all the dignitaries on the dais and all the participants for sparing your valuable time. As I mentioned earlier, that PhD Chamber of Commerce and Industry organizes programs, open houses, round tables, time to time for a better, effective policy advocacy with the government, so that ease of doing business becomes more and more prominent, and we are able to enhance our growth trajectory to the level of 5 trillion, 10 trillion, 20 trillion, or even 40 trillion, as projected by many forecasting agencies, that India will become a more than $40 trillion economy by 2047. This is the thought process behind the facilitation to our members and the industry stakeholders, so that ease of doing business becomes really prominent at the ground level. So with these words, I invite our dynamic chair, Mr. Anil Kumar Chopra, chair of the Direct Taxes Committee. He has more than 35 years experience in the industry, and he is very prominent in the policy advocacy of direct taxes in the national and international arena. Today's program is organized to discuss all the developments in the recent landmark judgment, and to deliberate upon such developments and make an effective representation for the government. With these words, I would like to invite our chair, Shri Anil Kumar Chopra ji, for the opening keynote address. Shri Chopra ji, please.
Thank you, Sharma ji. Thank you. Ms. Gauri Puri, Mr. Harpreet Ajmani, Mr. Rohit Jain, Mr. Gaurav Jain, Mr. S.R. Patnaik, ladies and gentlemen, welcome and thank you for joining us in this session. The topic for the day is a discussion on some landmark judgments. The judgments are to enhance our understanding of what has been decided, what is going to be the effect on these judgments, on all concerned, and practical aspects. Here in the chamber, the practical aspects are always relevant to us. We also have a quick session by Gaurav on faceless appeals and the recent e-appeals. Those are comparatively new provisions and important provisions from, again, a practical point of view as to what is going to be covered there, and very broadly, what is the process. From the point of view of judgments, High Court, Supreme Court, the law as it stands, the position in the field, there are many positive aspects. There are concerns. It is the stated policy of the government that the tax officers and the taxpayers are not on opposite sides. We are not in conflict. It is not like two parties to a dispute. At the end of the day, there is an act, we are citizens complying. And if I may say so, the citizen is also performing a service by doing his duty of paying the tax, which he must do in all fairness. But if a narrow view is taken, if a mechanical view is taken, if a purely pro-revenue view is taken, if one says, Kesab, there are two views. Now Supreme Court says you take the view favoring the cessee. Or if the officer says, sir, if there are two views, I have to take one taking the department. Or how am I going to answer? Why did I not follow this view? There are issues covered by High Court, Supreme Court, governing High Court, and High Courts as such are the law. Supreme Court is indisputably the law of the land. But if that is still not followed in the field by the assessing officer, there is concern. There is then due process, natural justice, fair play, equity, opportunity, specific opportunity. That too needs compliance. Very fortunately, we do find a large number of judgments that are giving the citizen, the assessee, his rights on all these aspects. Opportunity, due process, natural justice. If there are two debatable, reasonable views, then the view favoring the assessee. They are also keeping in mind the object of the provision, ease of business. Past decided cases that give the criteria and views on the propositions that are involved, they say we can certainly take guidance from them. This includes in reassessment, where there has been such a plethora of dispute. And if it was not for the Supreme Court that moved in using their constitutional powers, there was a huge number of cases, notices on reassessment that were going to be struck as invalid without complying with due process. Time barred. And thus, a huge number of assessments or reassessments would fail. But they gave the opportunity that let there be a deemed compliance in the interest of justice. My colleague Rohit will speak about the consequences and related aspects under reassessments. Penalty, Mr. Ajmani, Section 270, capital A, the successor provision to 271(1)(c). I believe you all have a good understanding of the act, so I am talking in that manner. And 270 capital A, again, one can borrow extensively from decided principles of 271(1)(c). But there is a new provision, 270AA, that you pay, settle by piece, get immunity, no penalty. And when you sort that, if that has not been given, then again, in all fairness, the Delhi High Court has said, Schneider Electric, that you please see the objective. The conditions are complied. the assessee is entitled to immunity. Please grant him the immunity. What are the conditions? Keeping in view the objectives. Government collects tax. Dispute is settled. Protracted litigation is avoided. However, the conditions include that you can't file any appeal. So if you have a small addition where there could be penalty and you have a much larger issue, then you are not going to take this immunity. But there is something which is there and the objectives are being seen and kept in view to give justice. I touched JCIT appeals, faceless appeals. We all know that there is a huge number of pendency here. There is distress, there is hardship. The balance of convenience in any case is in favor of the department. If I am in appeal, first you make an overpitched assessment, then I am in appeal. Then you do not hear me or you do not pass a final order. There are issues on stay of demand. There are issues on my financial viability. There is a note on my accounts if I have such compliances in the nature of my structure. There's a contingent liability, which is perhaps unwarranted and unmerited, but it has to be disclosed and it's there. So even your chamber, PhD, took this up. We did make a passionate plea with the revenue secretary, chairman, board, and said, "Sir, please take these appeals up." And this was pre-budget, and we have found amendments to try now and hasten the disposal. So that will be very useful again. With these words, I think we can move to the first speaker. The system or model that we are following is there is one topic given to each of the eminent speakers. They're extremely learned, distinguished, and frankly, the time allocated to them is not enough because each one of them can go far deeper than I am requesting them to in the given time. So one speaker, one topic, and then anybody from the panel can add to it. And if you have something which you wish to clarify or add, please do so. But we will do Q&A and your suggestions at the end, please. Otherwise, it is tough for the speaker to keep his flow. The first speaker of the day is effect of Supreme Court judgment in the case of SAP Labs as to whether transfer pricing matters constitute substantial question of law under Section 260 capital A, and whether the High Court should entertain such appeals. And Gauri Puri from Shardul Amarchand Mangaldas will speak to us about it. She's a master's in tax from Harvard. I wish I had gone there. She's admitted to the New York State Bar and Bar Council of India, has several years' experience, is an expert in advisory matters. He's worked for several of the top companies, including Fortune 500 or Fortune 100 companies. Ladies and gentlemen, Gauri Puri, please.
Thank you so much, Anilji, and thank you, PhD. Always very kind, and I'm grateful for this opportunity to speak with all of you today. So the topic that's been allocated to me is the Supreme Court's recent decision on SAP Labs. And I think it's a very publicized decision. So I have a sense that everybody here would have some exposure to what the key findings were. But what I'm going to try and do today is just lend, my perspective, how I see this decision and what ramifications it may have as we go forward. So before I get to the decision itself, I thought it may be useful to set a bit of background here. When you look at the universe of transfer pricing controversies or issues, I generally, in my brain, being a lawyer, classify it into two parts. The first part I like to call it threshold issues, right? And these are issues where you're trying to ascertain whether the transaction per se, is it subject to transfer pricing at all? Well, you analyze if it's an international transaction. You'll analyze if the transaction is in fact between associated enterprises, if it has, trappings of a deemed international transaction and so forth. And I think there's fair consensus amongst courts and the tax practitioner community that these questions are essentially very raw legal questions. But the second group of disputes that we often see pertain to the transfer pricing computation process, because the end game in any transfer pricing process is to determine what that arm's length price would be. And that process, what I have on the slide for you, is basically divided into several steps where there is a painstaking factual analysis which is carried out by the assessee in the context of the transaction between the assessee and its associated enterprise, sort of delineating, what are the characteristics of property or services transferred, what are the economic circumstances within which the transaction occurred, the FAR analysis, so to speak, etc. Then trying to find out what would be the most appropriate method to benchmark the transaction, moving onwards to comparability analysis, risk adjustments, and finally arriving at the arm's length price. Now, prior to this, and I would say even now, I think again there is a broad consensus that this is essentially a fact-intensive exercise, an exercise where you have the transfer pricing expert or auditor or the transfer pricing officer, crunching large sets of data, analyzing the transactions, analyzing the comparables to carry out this analysis. However, this analysis doesn't really occur in the air because there is a legislative architecture which is prescribed under the Income Tax Act, as well as the income tax rules, within which that analysis is conducted. So we have guardrails as to when would two transactions be considered as comparables, what are the methods that are to be used, and how those methods need to be applied. Are they as detailed as OECD's transfer pricing guidelines? Maybe not, but the broad contours are there. And so I think that really is the crux of the SAP Labs decision, that is this transfer pricing process is it solely to be viewed as a factual exercise, or does it happen within the realm of law? And therefore, there is requirement to see if certain guidelines or principles have been followed while conducting this transfer pricing process. Again, before I get to the substantive decision itself, it's very important to understand the context within which the Supreme Court decision was rendered. And that came about from the decision of soft brands by the Karnataka High Court. Now, on the surface of it, the soft brands decision is a very routine kind of a case, right? You have an Indian enterprise engaged in the IT and ITS sector, as vanilla as it gets, rendering services to its foreign affiliate. TNMA method is applied. There are certain comparables that the transfer pricing officer has included, which the assessee wants to exclude because of lack of functional comparability. And there's also a related party sort of filter that has been applied at 15%, which the tax department is taking an opposition to. And so you have the tax tribunal give a decision ruling in the favor of the assessee, and the matter goes to the High Court. And again, on the surface of it, a very sort of a routine fact pattern where certain turnover filters and certain comparables are the subject matter of dispute between the taxpayer and the tax department. However, the reason why to me, this decision was not so routine was because the approach the High Court took from the earlier decisions we had seen on this issue. And I'll divide this discussion on two parts. So the way the High Court proceeds is that it looks at the specifics of the case. It records that the tax tribunal has in fact given a detailed or cogent rationale as to why the related party filter has to be applied, as to why certain comparables have been excluded. And as such, there's nothing really wrong in what the tribunal has done. Therefore, there's no substantial question of law, and therefore the High Court does not need to intervene or admit the appeal. This was not unique to the Karnataka High Court. This has been done in various other cases. And so I think till here, we're fairly, how do I say it? Again, within the standard realm. But what the High Court does, it goes a step beyond. Suddenly, from just talking about the specifics of this case, it goes to a more high level or policy level kind of adjudication on can the transfer pricing process ever in any circumstance give rise to a substantial question of law, because as we all understand, this is, like I mentioned, a fact-intensive exercise. And I think that became sort of the subject matter of what ensued and the dispute that has followed and reached the Supreme Court. Again, I'm going to pause here and come back to what really the High Court observes at this more high-level sort of perspective. Two policy considerations weigh in on the High Court. If you look, if you try to read their case, if you try to go between the lines. First, at several places, the High Court notes that if our economy is to grow and if international trade is to be promoted, then taxpayers need real-time certainty. You can't really sort of, keep disturbing the apple cart. And so you see them getting influenced by the fact that disputes need to be resolved in a timely manner. There should be some sort of certainty which is achieved, and there should not be long drawn litigation because that impacts the growth of the Indian industry. The other key consideration that plays on their mind, and again, you read this between the lines now and then if you see the judgment closely, is that they see the transfer pricing exercise as an exercise for specialists. In several places, they note that you have a transfer pricing officer, you have a dispute resolution panel, and then you have the ITAT. And all of these quasi-judicial bodies are manned by experts who understand how this factual or painstaking analysis is to be carried out. So when there is already sufficient safeguards in the system, should the tax department or the taxpayer be allowed to sort of prolong that litigation and knock on the doors of the High Court or the Supreme Court, the case may be. And if you see this broader policy context and then sort of see some of the general observations they've made, we are able to sort of appreciate the soft brands case a little better. And so I'll come back to how they then proceed. They then go on to understand what is a substantial question of law. And here a sort of comparison is drawn with Section 100 of the Civil Procedure Code. And the High Court then again goes to, all the generic case law that exists under the Civil Procedure Code to say that, look, in the transfer pricing context, if I'm thinking about a substantial question of law, then that should necessarily be a question that impacts the general public, or it impacts the rights of the parties that are involved in the dispute, or it has, or it relates to a situation where there's a debatable question of law and there's been a lot of controversy. And so try to sort of circumscribe what a substantial question of law is after going through a lot of case law on this issue. But when it comes to a question of fact, the High Court notes that, look, on a question of fact, essentially, there would typically not be a need for the High Court to intervene because that wouldn't fall within the realm of substantial question of law unless there was a perversity, unless there was some evidence that was brought on record and were not considered by the tribunal, or there were some irrelevant considerations that were considered by the tribunal. And so with this, after going through this exposition, the High Court then goes on to make certain generic broad statements, which I'd like to sort of quickly read out to you. So they say the entire exercise of TP adjustments on basis of comparables is a matter of estimate of a broad guesswork. The final fact-finding authority for Chapter 10 is the tribunal. Its decision to pick comparables, shortlisting application of filters are binding on lower authorities, tax department, and high courts. And so we see that going from a specific and a routine case, the High Court goes a little broader, a little wider, a little, I would say, a little more overzealous, and it goes on to make a very broad statement to say that any transfer pricing determination by the tax tribunal is final and binding not only on the lower authorities, but also on the High Court. And that the High Court would not, in such a situation, interfere with the transfer pricing analysis for two reasons. A, that it does not have the expertise or wherewithal to carry out a transfer pricing study itself. And two, because until unless there was a perversity which was established at the tribunal level, they don't believe that in any circumstance a substantial question of law would arise. Now, your takeaway from this case, because I've read it 3 times over the last week, and each time I look at it differently, can be at 2 levels. If you just pick out the specific, you say, yeah, so there's nothing wrong. They're saying that as long as there's no perversity, you should not be sort of interfering with the decision of the tribunal. And they applied their mind and they noted that the tribunal has, in fact, taken full note of the arguments that were made by the taxpayer transfer and the transfer pricing officer, and finally decided that these comparables need to be excluded. So there was no perversity and there was no need for appeal. But if you're looking at it from a more general perspective and you look at these general observations on a standalone basis, then it seems to suggest more. It seems to suggest that maybe what the High Court is saying is that there cannot be any scenario where the transfer pricing determination by the ITAT can ever be considered in appeal by the High Court. And I think that's what really happened. In the aftermath of the Karnataka High Court's decision, the ecosystem within which we operate, which comprises of the tax department, the taxpayer, other high courts and tribunals, a large view that came out was that maybe that's what High Court was saying, that it is not possible for the courts to ever question a transfer pricing determination which becomes final at the stage of the ITAT itself. And as a result of which, it appears that a number of cases, a number of appeals were rejected because the generic proposition was seen as the rule of law which came out of the High Court's decision. It is in this context that we see the Supreme Court give the decision in the case of SAP Labs. Now, what's interesting to me is that this perspective on how you look at the decision was also how the revenue and the assessee was arguing the case. The revenue picked up the generic side of the case, and their problem was with that broad proposition of law. And they said there cannot be an absolute proposition that no appeal can ever lie from the ITAT on issues relating to determination of the ALP. The High Court, ultimately, like I mentioned, the arm's length price or its determination doesn't really exist in vacuum. There is a legislative framework. And so the High Court should at least verify if that legislative framework has been followed by the tax tribunal. But if you see the assessee's argument, and again, very interesting, the Supreme Court notes every time the assessee was trying to bring the court back from this generic piece to say, no, that's not what the High Court is saying. Look at what they in fact did. Look at the specifics of the case and the factual background within which this judgment has come. the High Court did go into the question of whether what ITAT had done was perverse or not. And so they did give a finding on that. It wasn't that they merely dismissed the appeal on the basis that no appeal can ever lie, and that's about it. So let's go into the factual part. What they felt was that the revenue was taking the Supreme Court more towards the more generic part while arguing, the case before it. And here again, the question was, what would be perverseness in a transfer pricing case? And again, we see the assessee sort of bringing out three things. Perverseness would mean either that no evidence was brought on record, or while arriving at such finding, relevant evidence was not considered, or finally, legal principles have not been applied in appreciating the evidence. And so the assessee finally argued that comparability, selection of filters are actual factual exercises, and unless perversity is shown, there should not be any intervention by the higher courts. If you see the Supreme Court's decision, the Supreme Court again sort of leans in more on the general proposition that was laid down by the High Court. And the Supreme Court says any determination of the arm's length price which does not fall in line with the transfer pricing guidelines is in fact an example of perverseness. It's another, how would I say, a use case of perverseness. And therefore, there cannot be an absolute proposition of law that if a transfer pricing determination has been made by the tax tribunal, that is final or that is set in stone. It would be very much open for the high courts to go into these questions of turnover filters and comparability, etc., if the transfer pricing guidelines have not been followed, and see whether these filters or these issues of comparability have been determined by the tribunal judiciously. So where does that leave us? And I think it leaves us at the same crossroad where we were after the High Court decision. How do you see what the Supreme Court says? Do you see it as a statement which allows the High Court, or requires, in fact, the High Courts to go and carry out the transfer pricing process or examine it painstakingly in detail? Or are we back to where we were, where what's expected is a broad smell test to see that, the transfer pricing guidelines have been followed, that the tax tribunal has given cogent reasons for either including or excluding a comparable, for applying a turnover filter or not applying a turnover filter? And I've heard both. If you go again back into the ecosystem within which we all work, there are certain practitioners who are taking a view that no, I think what the Supreme Court is saying, the High Court can go into that full-fledged analysis if it wishes to do so. Or the other side which says no, Supreme Court is not giving a sort of a license to file an appeal, to sort of have the whole transfer pricing process reviewed every time you're not happy with the modification of the lower court. All it's saying is that the High Court has to apply itself to see whether these guidelines have been broadly applied or not. And I think what will follow in the next few months is whether there is an exercise of judicial restraint, or do they sort of see this as, a Pandora's box which has just been opened, which then is concerning, because not only India, globally, transfer pricing disputes are the major cause for litigation. And even in India, over the past few years, while we've seen the government take a number of measures such as advanced pricing arrangements, safe harbor rules, the availability of MAP for TP, this still becomes the core or central point of where litigation is currently focused. And like I said, as we move forward, businesses want real-time certainty on the transactions they're carrying out. And unless there is a judicial restraint, unless we don't sort of understand as an ecosystem and appreciate the Supreme Court's decision for what it is, this could lead to a situation where, appeals are being routinely filed to the High Court, routinely being admitted and then being remanded, because the truth is that the High Court's not going to carry out a transfer pricing study. And the matter goes on and on and on. And I think the next few months are going to be very, very important to see how this really plays out in courts. I understand that there have been some decisions where judicial restraint has again been exercised. The courts have noted that, yes, the tribunals have applied their mind to the transfer pricing process, and therefore there is no need to admit the appeal on a substantial question of law, but we'll only know as we go forward. I think one key takeaway for me as a tax practitioner is that it becomes now very important for you to sort of have transfer pricing documentation, and even when you're arguing in the court of law, have your arguments very neatly juxtaposed against the rules. So for instance, if you are arguing on an issue of, let's say, a turnover filter or your related party filter, it's important that you identify within the guidelines which is the broad rule which impacts that application of filter, and how that rule is being satisfied by the choices that you have made. Or if you're filing an appeal, how is that rule not being satisfied? So the way in which we structure our arguments may change pursuant to this decision as we move forward. So I hope I've not exceeded my time, but I'll stop here.
If I touch in a few words as to what the High Court says, and it can cut both ways. It is the cessee who could also have been aggrieved, not only the department. And what will need to be shown for the High Court to say there is a substantial question of law here, and they have said this, is that the act and the rules have not been followed, or that the order is perverse. So order being perverse is again something which we understand, act and rules we understand. Finally, any case, whether it is transfer pricing or other matter, is on the facts of that case. So how the counsel will demonstrate that on his facts, the act and the rules have not been correctly applied, or that the order is perverse. And yes, there are aspects of selection of comparables and one or two other such aspects which he has very well mentioned. But the fundamentals will continue to be that, act and rules on your facts. And the party which has succeeded before is going to say this has already been followed, you do not go into this. There are settled principles and clear interpretation of the act and rules that have been followed. Settled principles of transfer pricing. Anyway, let us see. As she said, there is more to come. But as far as you all are concerned, it cuts both ways. If there are matters where you believe the judgment of the tribunal or the department was unfair, adverse, and without merit and unlawfully so, then you will have a chance to sort that out, rather than what Karnataka said is there is no question of law in a transfer pricing case. So 260 capital A does not apply. Our next speaker is Mr. Harpreet Ajmani. Harpreet will discuss penalty under section 270A, the interplay between underreporting, misreporting, and what are the principles of 271(1)(c) that will still continue to hold the field while interpreting 270 capital A. So many of these settled principles are already there. Specific notice, debatable claims, settlement to buy peace, bona fide explanation with all material facts disclosed. These are well-known principles, but what do they say? Mens rea for misreporting, not for underreporting, and others. It is going to be very interesting to listen to him as to his view. Harpreet is a lawyer, a company secretary, an advocate on record in the Supreme Court. He has over 12 years experience. He's an expert in both advisory and litigation aspects of corporate tax as a whole. And there is a focus on international tax and transfer pricing. He has been involved in cross-border investments, planning and structuring. He has represented his clients before various forums in India. Ladies and gentlemen, Harpreet Ajmani, please.
Thank you, Anil ji. Thank you, PhD Chambers, for inviting me here. As you have very rightly pointed out that 271C, 271(1)C and 270A. 270A, as was inserted by Finance Act 2016, it is applicable with effect from 1/4/2017. How I see it is that there has been a paradigm shift in terms of the whole provision which was there earlier vis-a-vis now, the provisions which are there as on date for levy of penalty. Now the focus is on underreporting and misreporting. These are the key terms which I would be dealing in detail during this presentation. However, how I see it is that even now, the law as was laid down by Supreme Court in Dharmendra Textile, that levy of penalty is nothing but a civil liability, and it is in the nature of compensation. It is only compensatory in nature. So, as in Dharmendra Textile, the Supreme Court has held that principally, I don't see that the element of mens rea, even in context of misreporting, which in the later part I would be dealing with, that misreporting is only a phase of underreporting. Underreporting is the bigger piece, and misreporting is one of the phases as a part of underreporting. So first element is that still the law as it was declared earlier by Supreme Court, that penalty is a subjective exercise. It is a civil liability, compensatory in nature. To my mind, would still hold good even under this new regime of 270A. Now, as far as levy of penalty and the different facets of it are concerned, the penalty in itself being a part of the whole assessment proceeding, because the trigger point is that where during the pendency of any proceeding before an authority, he may be a commissioner of income tax appeals, maybe the assessing officer, maybe the principal commissioner. These are the different authorities provided under the statute who may, during the pendency of any proceeding before them, initiate and invoke penalty under 270A. The trigger point being that where they believe that there has been a underreporting of income. As far as underreporting of income is concerned, under subsection 2 to 270A, there's a deeming fiction. Vis-a-vis when I compare it to the erstwhile regime, where the prerequisite was that there has to be an inaccurate particular or concealment. Now under 270A, there's a prerequisite or there is a deeming fiction. The statutory presumption is that based on certain criteria, which I would be just dealing with, there is a presumption that there is underreporting. Like the first criteria being that whenever there is a variation between the returned income and the assessed income, whatever may be the basis for that, but once there is a variation, there is a statutory presumption that yes, there has been an underreporting. Similarly, when I have not filed my return of income, the assessing officer picks up that matter, and maybe on account of alternatively, where pursuant to a reassessment notice being issued, I filed my return, and post-assessment there is a variation. In another angle could be where under 115JB, I have declared some income, and still there is a variation between the assessed income and the returned income. In all these scenarios, different permutation combination, there is a deeming fiction, there is a statutory presumption that there is underreporting. So this is a given that on account of variation, there is underreporting. Now the legislature in its wisdom has similarly, in line with the erstwhile regime, that under 273B, there was a provision that I was given an opportunity to show my bona fides, that based on my documentation, based on my material facts, I can establish that I can say that I had maintained my documents in good faith. And if the variation is there, it is only a bona fide mistake. It's just a mode of difference of opinion between how the assessing officer looks at the transaction vis-a-vis how a assessee looks at the transaction. This is how Reliance Petro has declared it in the Supreme Court. Similarly, now these statutory defenses are envisaged under the statute itself, where all these defenses, this under subsection 6, multiple defenses have been provided, where the assessee, to overcome the statutory presumption, is now given an opportunity to show cause by the assessing officer that first the disclosures or whatever would be the justification for underreporting, that is the difference between the returned income and the assessed income, was on account of all the true and full disclosure was made in that, and the difference which is there is on account of some bona fide mistake or a difference of opinion. Second defense would be that the accounts have been correctly and completely maintained, and it is the difference is only on account of the methodology employed. Third defense could be that where a suo motu disallowance was made, on account of that suo motu disallowance, but everything else was disclosed. All the documentation were properly maintained. As far as transfer pricing is concerned, the defense could be that the transfer pricing documentation was properly maintained. As prescribed under section 92D, the transaction was duly disclosed, whether be it international transaction or a deemed international transaction, but the same was duly disclosed by the assessee. And all the material facts involving in respect to the variation, which is the main cause of variation, all the details in respect to the same was duly disclosed by the assessee in its return of income, and the documentation were there. So in that background, the complete defenses are now have been described in detail by the legislature under the provision itself, rather than keeping it a vague and general provision as it was there earlier. Now a full length of defenses, what would be available to an assessee, have been described. Although again, this is a subjective exercise because these are all fact driven, they are fact based. So if I am like in the erstwhile regime, if I am claiming depreciation at 10% or if I am claiming depreciation at 60%, naturally there would be a difference of opinion under which category the asset would lie. And that cannot be the reason for levy of penalty. That could be a bona fide mistake on the part of assessee, how a particular asset is being characterized. So all these things have now been statutorily provided under the Act, under 270A itself. So the defenses are there, the statutory presumption is there. Now, based on this, the assessing officer has to apply the law. Give me the show cause notice. The 274 notice would still be there. He has to give me the notice. And now under 278, well, he has to pass a speaking order, which was the criteria even earlier. So there is similarity as well as variation. The similarity is that the procedure of giving an opportunity, passing a speaking order, these things are already subsumed. They are in line with the earlier regime. The difference being the statutory presumption, which has been included, the defenses which have been specified are there. The most interesting part, how I see it, is that the legislature has now tried to carve out a distinction that within the same provision, they are saying that there may be underreporting, the multiple instances which I have discussed on account of variation. However, where the underreporting is on account of misrepresentation or suppression of facts, or alternatively, the underreporting is on account of failure to record an investment in books of account or claim of expenses not substantiated by evidence, reporting of false entry in the books of accounts, failure to record any receipt in books of account having bearing on total income, or failure to report an international transaction. This is an exhaustive list of 6 categories. When a matter of underreporting is falling in any of these 6 categories, it would tantamount to misreporting. What is the difference between underreporting and misreporting apart from the conceptual difference? For underreporting, the penalty is of 50%, whereas for misreporting, the penalty is of 200%. So there's a huge variation even in terms of quantification of penalty and vis-a-vis the criteria which has been laid down. Now, as far as misreporting is concerned, misreporting is specifically defined in subsection 9 to 270A. My reading of subsection 9 is that as far as the element of misreporting is concerned, the burden of proof is on the assessing officer, because now it is the duty of the assessing officer to establish that out of these 6 categories where my matter will fall. Merely giving a general statement that there is a variation would not lead to making the assessee to fall in under the category of misreporting. He has to specify that under which specific charge or under which specific limb of subsection 9 he is making an allegation that there has been a misreporting. In the same line, there has been a recent judgment of Delhi tribunal. Sorry, it's a case of Mumbai tribunal in the case of Saltwater Studio. On the same difference, even in the case, the Bombay tribunal has followed the same logic, that there has to be mentioning of a specific charge by the assessing officer, that under which limb out of these 6 limbs the assessee is being held that there is a misreporting of income. The next part which I would just like to highlight is that as far as the erstwhile regime is concerned, apart from this burden of proof and the other subjectivity which were involved, to my mind now the legislature has brought in a lot of crystality even in terms of the quantum of penalty. The crystallization is because in the erstwhile regime, the assessing officer can put a levy up to 3 times. There was no specific thumb rule in which case he has to apply 100%, in which case he has to apply 300%. It was completely his discretion. Now that discretionary element is more or less not there, because either it could be 50% or 200%. There is no other options which have been given to the assessing officer. So I think this is another shift from the erstwhile regime vis-a-vis the current regime is concerned. Another interesting facet what I see in terms of resolution of dispute and to avoid protracted litigation is this 270AA, which has been introduced as an indemnity or a mechanism, immunity for imposition of penalty which has been given, and it also captures the offences prescribed under 276C and 276C, 276CC. So it is a very important part to 270AA. It not only gives an option to the assessee that if a assessee feels that he does not have a bright case on the merits as far as the penalty is concerned, rather than opting for an appeal, he should immediately pay and deposit whatever the amount would be under the assessment. That statutory limit of one month has been prescribed that he should not file an appeal. Once these basic criteria are satisfied, the assessee may avoid this protracted litigation by just making payment of the taxes as it is. But naturally, this would be a subjective exercise and the assessee has to take a call depending on the multiple facets on which the additions have been made. As Anil ji was earlier referring, that he may have a very strong case on one issue, but on multiple other issues, the issue may not be in his favor. So this would be a commercial decision where a assessee has to be alive of that what are the pros and cons when he is taking the decision whether 270A indemnity is to be exercised or not, or the immunity has to be exercised or not. So this would be very fact driven, but yes, the legislature wants or the government wants that this kind of litigation may be avoided. Another facet here would be that the judgment of Schneider, what has been referred, the Delhi High Court has also taken the same view. It's in the same line, and Schneider was thereafter again followed in Premnath's judgment, where again the same view has been taken that even once the legislature wants to avoid litigation, unnecessary protracted litigation, then it is the duty of the assessing officer also to exercise the jurisdiction under 270AA4. Because once an application is made under 270AA, based on the bona fides and the content of the application, it is the assessing officer who has to examine the facts and thereafter allow the application. To my understanding, the assessing officer's role is very limited because under 270AA clause 1, the condition is there are only twofold conditions. First is that whether the taxes have been paid or not. Second is whether I filed the appeal or not. Only under 270AA4, AO has not to go into the merits of the matter. He is only required to see that whether these two basic conditions have been satisfied or not. He is not to do anything else. But even after these two simple conditions to be seen, the assessing officers are sitting over the applications. They are not passing the orders. And this is where the courts have to step into and they have to give a specific direction that you have to grant immunity. You don't have a choice. The officer does not have a choice once both these two conditions are satisfied. It is a matter of right that the assessee has to be given immunity and the officer has to pass an order. It is in this context that in Schneider, the court has not left any room for the assessing officer whether he has to examine the documents or do anything else, because these two facts were already there. He has to just pass the order and grant the immunity. So I think this is a very important step where the legislature is now trying to avoid protracted litigation. I've captured underreporting and misreporting. I think I will not, my time is already there. So please, thank you so much.
So thank you, Harpreet. That was very useful. And yes, I think we need to keep a little more time, but you have well covered various aspects. There still are various more to be covered, but in all fairness to him, he doesn't have the time, such as, does the ITO or AO have to record satisfaction in the assessment order? Does the penalty have to be initiated in the assessment order or proceeding? Because 270A subsection 1 says in the course of any proceeding. So the initiation has to be there in due course. Satisfaction should be recorded. He would do well to do that. And the specific subclause under which he wishes to fasten the penalty, that must be put to the assessee, because if he doesn't do it, it is going to get quashed. That is what the higher courts are going to decide. Having said that, we leave it there for a moment. Mens rea for misreporting. There has been a ding-dong on mens rea. And the latest is what he said, that no mens rea is required, say, in 271(1)(c, for the reasons that he gave. But misreporting, which talks about misrepresentation, false entry, here there is an element of the mind which is involved. And once again, this aspect is going to be argued. There is a view that mens rea is required. It is for the courts to decide. The best thing any assessee can do is not get into any situation where he needs to argue all those points. Be diligent and comply. That is the best advice one can give an assessee. And having said that, on an overall basis, the misreporting has to accompany the underreporting. So the provision that says if you have a bona fide explanation which is substantiated and all material facts are on record, then there is no penalty on you. So that explanation can be there, be it a debatable view that you followed or a CA's advice that you took, who's a reputed, competent CA who gave you a diligent advice with due care. All these aspects are there. Thank you, Harpreet. You've covered it very nicely and thoroughly. Our next speaker is Rohit Jain, who's a qualified CA and advocate, a senior member of the tax group in Vash Associates. He has more than 20 years of experience across the board in tax matters, advisory, litigation, structuring, planning, related tax laws like Benami, Black Money Act, even what is not mentioned, I'm mentioning. And what he will be talking to about is reassessment, but in a focused manner. You can have propositions galore on reassessment. 20, 30 years back, these words used to be used when we used to be in conferences. When will we stop having reassessments galore? And the first person I heard, if some of you are elder, comparatively speaking, everyone's young. My friend Ashok Goel is there. There was a very eminent senior advocate, GC Sharma ji, and he's the first one I heard saying reassessments galore kab rukengi, and telling the board about that. That still continues to be true. We need to put a stop to it. Now the High Court observes that yes, these amendments, the new scheme, and today we are talking about the new scheme. We can take propositions from the old scheme also on settled propositions to interpret. But they said the objective has been ease of business, certainty in the new scheme, to protect the rights of the citizen. Put one notice to him, give him opportunity, give him all the material. Then you decide, yes, this reassessment needs to be done. Then you give the final reassessment notice. So there are multiple levels of process and opportunity in all fairness. And they have said this is not something to be done just for tenuous information. So there still needs to be something substantive. Even if the words is reason to suggest, there still has to be escaped income, which was liable for tax. Two specific points, 147, 148 reassessment, Rohit, under the new scheme, and whether TOLA will extend the period for certain number of years, such as 13, 14, 14, 15. Matter is before the Supreme Court, but there is an issue here. And what really is it that constitutes information which would justify a lawful reassessment under the new scheme? Rohit Jain, please.
Yeah, thank you, sir. Chairman of the session, Anil sir, co-chair Palvi, my co-panelists, and everyone present here. A very good afternoon to everyone. First of all, thank you, PhD, for giving me this opportunity to be part of this eminent panel and these sessions which has been organized. The topic which has been given to me actually is one of the issues which has actually kept us busy for last two years, and I think for another 2-3 years this issue will continue to keep us busy as lawyers and professionals. And the law was amended by the Finance Act 2021 to make it easier, a so-called reformative section to make life easier. But I think, as sir said, reassessment actually is galore. The notices are being issued. And what was not actually appreciated was the reason of moving from the old regime to the new regime was to make it a more streamlined process. Whereas when department realized that all the earlier notices till assessment year 2000, probably 15, 16, etc., are going to get time barred under the new law. So lock, stock and barrel, all notices were issued from 2013-14 to 2017-18. And I think that's where the problem started. Now, coming back and focusing to the issue which has been asked to me to address is the interplay between TOLA and the effect of TOLA on assessment year 2013-14 and 14-15. So in order to put the controversy in perspective, just stepping back for a moment and As we all know, the scheme was amended in 2021. The old scheme of reassessment laid down the limitation of 6 years. So for 2 assessment years which we are concerned with is 2013-14, this 6 year was expiring on 31st March 2020. And similarly for assessment year 2014-15, the 6 year was expiring on 31st March 2021. Now the COVID came in between, and because of the COVID, the TOLA was brought in by the government to extend the limitation for issuing notices under various provisions, which obviously included the reassessment notices under the old law. Now what the TOLA did was, TOLA extended the limitation from March 2020 to March 2021. All those actions which were required to be done within this period, it was extended till 30th of June 2021. Now in between, while this, this TOLA was being implemented, 2021 amendment was made by the Income Tax Act to came out with a new reassessment regime. Now the controversy was as to under which law the reassessment notices are required to be issued between the period 1st April 2021 to 30th June 2021, because from 1st April 2021 onwards, the new reassessment regime had kicked in. Now there was a CBDT notification which was issued, which said that the notices will be governed during this period when TOLA was in operation. It will be governed by the old procedure. So basis their understanding, the Income Tax Department issued notices for all the assessment years during the period from 1st April 2021 to 30th June 2021 under the old law. So obviously all those notices were subject matter of challenge, and as we all know, it's history that Delhi High, except one High Court, all the High Court quashed these notices which were issued between this 3 months period on the ground that from 1st April 2021, the new law has come in, the old section, the old provisions were repealed, and there was no saving clause. So once there was no saving clause, the notices, reassessment notices can only be issued under the new law from 1st April 2021 to 30th June 2021. The matter then traveled to the Supreme Court. The Supreme Court in Ashish Agarwal, in order to save the day for the Income Tax Department, said that there is a bona fide mistake. They said that all the high courts are right in saying that the new old law would apply, but they all the same side said that there is a bona fide mistake which has been committed by the Income Tax Department, and that would lead to lakhs of notices becoming invalid. So what the Supreme Court did was, Supreme Court said that as a matter of by exercising their constitutional powers, they said that what we will do is we'll say that all the notices which were issued during this period, they will be deemed to be notices under 148 AB, and then the assessing officer will require to follow the new process. But at the same time, the Supreme Court in the judgment said that all defenses which are available under the new law will continue to be available, which obviously included the defense of limitation, which is under section 149. Now, as we all know that under 149, the new law, there are 2 limitations which are available and subject to grandfathering provision. One limitation is the 6-year limitation stands reduced to 3 years limitation. And then another 10 years has been permitted, and that 10 years is not the 6 years which has been extended to 10 years. Actually, that's 10 years brought in from, because 10 years was there under the search provision. That's a separate controversy altogether. But for our discussion, the point is that the limitation is 3 years for all old provisions. And there was a grandfathering provision which said that till assessment year 2021-22, the old limitation will continue to apply. And that is contained in first proviso to section 149(1), which says that the assessing officer, if he could not issue notices within the time specified under the old law at the time when he is issuing the notices, then in that situation he cannot issue the notice under the new law. Now it is here the problem arises. Now for 2013-14, as we've said, the limitation under the new old law was 6 years. So therefore it expired on 31st March 2020. And for 14-15, the limitation, 6-year limitation expired on 31st March 2021. So both limitations expire prior to 1st April 2021 when the notices are being issued under the new law. The section first proviso to 149(1) says, if the notices could have been issued within the time specified under the old law, you can issue the notice under the new law. Now the issue over here is, if you see the language of the section, it says within the time specified in 149(1)(b. The time specified in 149(1)(b) was 6 years. So the issue is whether 6 years has to be further extended by the period of TOLA, or you have to stop at 6 years. If you can stop at 6 years, then obviously the notices for 2013-14 and 14-15, which time limit has already expired prior to the new law coming into force, they are time barred. But if the old limitation of 6 years is further extended by those 3 months, which are given by TOLA, then those notices would be valid. That exactly is the controversy which actually is presently, being there, and there are conflicting views. The Delhi High Court in the case of Touchstone, and there is one more judgment, has said that the 6 years period plus those 3 months period permitted the assessing officer to issue notices under the old law. So since 6 years plus 3 months were permitted under the old law, the notices which are issued for 13-14 and 14-15 till 30th of June 2021 are valid notices. So what effectively the High Court did was, it read the TOLA limitation into first proviso to section 149 and extended the 6 years by another 3 months or 1 year and 3 months for 13-14 to say that that limitation is also available under the new law. Whereas a different view has been given by Allahabad High Court and the Gujarat High Court, wherein they have said that from 1st April 2021, what is available, what is effective is the new law. And the TOLA was brought in under the old law. Old law stands repealed. There is no saving clause. So therefore, from 1st April 2021, there is no old law. If old law cannot be there, the TOLA which was there to implement the old law cannot be applied. And therefore, the extension which has been granted by TOLA for 3 months or 1 year, 3 months cannot be read into the new law. If those extension cannot be read into the new law, then for assessment year 2013-14 and 2014-15, the notices are invalid. The matter as it stands today is, rightly or wrongly, the SLP against the Delhi High Court judgment has been dismissed. So effectively, the Delhi High Court stands. That of course is, there is no merger which has happened, because that's a simpliciter dismissal of the SLP. And the judgments of the Allahabad High Court and the Gujarat High Court, the operation of those 2 judgments have been stayed by the Supreme Court. So there are 3 judgments today. One, Delhi High Court taking a view that those notices are valid. And there are 2 judgments of Gujarat High Court and Allahabad High Court whose operations, though have been stayed by the Supreme Court, they hold that those notices are invalid. According to me, this is a very nuanced issue, because according to me, the Allahabad High Court and the Gujarat High Court, though may have decided, the conclusion may be right, but they have actually not looked into the first proviso to section 149. Because if you see 149 first proviso, it specifically takes us to the old law. Because it says that you have to see the limitation under the old law. And if the limitation under the old law is available, then the notices can be issued under the new law. What they have simply said is that the old law stands repealed, no saving clause, and therefore you cannot refer to the old law, which probably my understanding is not correct, but the conclusion which they have arrived at is probably correct, because the Delhi High Court has imported TOLA into first proviso to section 149 without there being a statutory mandate in 149(1). Because 149(1) proviso nowhere says that 6 years period stands extended by the TOLA bill. It says within the time limit specified in clause B of section 149, which was there in the old law. It never said 149 read along with TOLA, or TOLA never said that the 6 years stands substituted by 6 years or the plus the extended period. So I think that's where the controversy lies, and I will leave it at that, because that is the issue is sub judice, that this matter is pending. In fact, even today the Delhi High Court, though not specifically, is entertaining the appeal, the writs for 2013, 14, 14, 15, though of course all those issues might be closed now, but they were prior to the vacations entertaining the writs for 13, 14 and 14, 15 also. They were being granted not specifically on the issue, but they were considering the issue, other issues also. So that is where the issue, this issue stands as of now. The second issue, the second aspect which I have been asked to, deliberate upon is what is the scope of, the term information? Because as we all know, the concept of information, of course, information was there earlier also prior to the amendment, but the information has now been defined in section 148. And there have been few changes which have happened in the definition of information. So up to 31st March 2022, from 1st April 2022 to 31st March 2022, the information was defined to mean risk management strategy and the objections by CAG. And from 2022 onwards, the definition of information has been amended to widen it to include audit objection, risk management strategy, treaty information, consequences of order of tribunal and court, and the information under 135A. The aspect which I just wanted to highlight, considering the time constraints, and that important aspect is there, and which probably has been missed out, may have been missed out by many. You see, the information was defined to mean what is risk management strategy. If you look at the notifications for the risk management strategy, the notification was for the first time notified in December 2021. So from 1st April 2021 till 30th of June 2021, when the department has issued notices to me, or from 1st April 2021 till 10th of December 2021, when the department has issued notices to me, by applying the new law on the ground that they have information as per the risk management strategy, which risk management strategy itself was not defined by way of a notification, are suspect. Because when the information was itself defined on 10th December 2021 as to what constitutes a risk management strategy, then how could the notices being issued from 1st April 2021 till 10th of December 2021? That I think is maybe an argument which will be available to all of you when these notices are contested. Apart from that, the definition has been widened, and it has been widened too much to include even the consequences of an order of the tribunal or a court. So I think that again will be a highly litigative issue as to what constitutes the information as a consequence of the order of the tribunal or a court, and all treaty information, etc., etc. So there can be so many information which can flow to the assessing officer, which could be ground for reopening of assessments. And as Anil sir said, there will be reassessment galore again, and even under the new regime. Thank you so much.
Thank you very much, Rohit. That was extremely well explained. I may retouch that we are in Delhi. There is a Delhi High Court decision on this issue of is 13, 14, 14, 15 time barred. There is an adverse decision, Salil Gulati, and SLP against it is rejected. And as he said, it's in a one-line order. So once the SLP is not a speaking order, it's not a discussed order, it does not have binding effect and full effect for others. Both the Allahabad and Gujarat judgment, which are in favor of the SECI, department has gone to Supreme Court. The orders have been stayed, but notice has been issued. So the issue continues to be live accordingly in the Supreme Court for their final decision. And it is for that reason that despite Salil Gulati, Delhi High Court adverse decision, having an SLP rejected against it, Delhi High Court continues to admit writs on this issue, though they are being kept pending till the Supreme Court decides. Some interesting things on information, because it is one of the fundamentals. And some of the old propositions will continue to stand, as I touched. And I am only saying what the courts are saying. So fortunately, we now have some judgments which are there to give us some clarity, some guidelines on what is going to happen. In Excel commodity, Calcutta High Court, the case was opened for some ground. And then the notice was finally issued and proceedings continued on a fresh ground, because the ground on which they were opened was satisfied by the assessee that there is no escapement of tax in this case. I believe my friend Gaurav Jain has also won a matter. He's here with us in Delhi High Court, which is similar, but he may like to tell the exact details. He argued it, again, subject to time, but he will be the next speaker. So fresh ground may not be permissible, but finally it is all a question of totality of facts and law in a particular case. Divya Capital, Delhi High Court talks about what we are saying, that it was a new scheme to reduce litigation and promote ease of business. And then the information again, that some of the earlier benchmarks of the decisions are there, and these things can be considered. And they also go on to say it can't just be any information. It is that where there is a reasonable view of escapement of tax, which should also be there. Of course, the Divya Capital, where I started today, that the courts are very strong on due process, due opportunity, due compliance, in all fairness with justice. So they have said, if you have done this without giving information, documents, material that you have relied to the assessee, and in that case, enormous sum of money, maybe in a lakh crore or some such figure, taking the totality of sale which related to futures, options, derivatives, all sorts of things. And that was taken as taxable income, but without giving the basis, the documents, the opportunity. So it was not sustained. In Dr. Matthew Cherian, Madras High Court, they say information must prima facie satisfy requirement of escapement from tax. And there must be a proper nexus with information and escapement of tax. So proper nexus should be there. And then the old principles, can there be proper nexus if it's a fishing and roving inquiry? Can there be a proper nexus if it is just reason to suspect as distinct from reason to believe? Can there be a proper nexus if it is a mere change of opinion on the same facts? So all these aspects will be there, and our bright counsels who are here with us, they will be arguing these matters going forward. But it was supposed to be ease of business. Some improvements are there. Some matters are being dropped in the course of process and compliance by the assessees. Let us see what further emerges here. Our next speaker is Mr. S.R. Patnaik from Cyril Amarchand Mangaldas. Mr. Patnaik is also a chartered accountant and lawyer. He has more than 25 years experience. Whether it is international tax review or leading tax lawyers by Asia Law, his name has been up there in the league tables, in the decorated distinguished people. He's into domestic and international tax, advisory, litigation, and other aspects which are there on relating to structuring of transactions, cross-border, inbound, outbound, inbound, outbound, international tax. He is the right person to also talk to us as to whether a tax residency certificate is binding in the case of a double tax avoidance agreement. Can a person, the department say, you have a tax residency certificate of residence in another country, but that TRC is not binding on us, it is not decisive, we will go behind it. And this is despite this being not a new, but now an issue which has been there for a long time. In fact, it is the government which in some cases defended this, that our circular saying that TRC is binding is lawful and correct. But today, again, some cases are being taken up that the TRC will not be decisive and binding. Very correctly, the courts have come, Punjab and Haryana, Delhi, Brandix Holdings, Mauritius is one such case. He will talk more about it, that the TRC under DTAA is decisive. And in fact, the courts talk about government assurances, that they are sacrosanct, they are sacred. and that now we should not tinker with them. Ladies and gentlemen, Mr. Patnaik, please.
Thank you, Mr. Chopra, for the kind introduction. My esteemed guest in the panel and ladies and gentlemen. I think, what I would like to do is I'm trying to, talk about how this actually became an issue. Because so far, when there was no significant amount of international transactions that were taking place, there were no benefits that were being availed by the taxpayers, it was not an issue. But with the increasing internationalization of Indian businesses as well as overseas businesses who are doing their business in India, there has been a significant amount of issues that are coming up. And most importantly, from a tax authority's perspective, they're trying to challenge whether or not the taxpayer who's trying to claim benefits of the benefits available under a tax treaty is available to it or not. Now, once we look into that, I think Mr. Chopra talked about, this was not even an issue. It became an issue because of a clarification issued by the government of India to clarify that the tax residency certificate should be the compulsory requirement, and once you have got the tax residency certificate, that will entitle you to claim the benefits of the tax treaty. Now, this was challenged before the Delhi High Court in the famous Azadi Bachao Andolan, and then subsequently the matter went all the way up to the Supreme Court, and at the Supreme Court very categorically clarified that yes, once you have entered into a double taxation avoidance agreement in your capacity as a sovereign country, you need to respect that. You cannot just do a to and fro, or you cannot have a secondary, check on whatever has been issued by another sovereign country, and you cannot really challenge it. Now, the issues are, pretty simple. When you're looking at a tax residency certificate, I think when you're looking at a tax residency certificate, the basic issue is when you, as a non-resident, you have gotten a tax residency certificate issued by your home country, and you're trying to claim the benefits that is available under the treaty in India, right? So this is the situation that we are talking about. Now, the provisions that are there in the Act has been introduced subsequently, through 2012. I'll come to the 2012 Act because that was one of those amendments which have become a significant amount of concerns amongst the international investors, primarily because of the aftermath of the Supreme Court's decision in the case of Vodafone. So what it talks about is, if you are providing a certificate, that certificate should be sufficient. Now, initially, when it was proposed in 2012, they had talked about that, okay, this may be one of the compulsory, but not necessary, the ultimate benefit that you can claim by furnishing a tax residency certificate. But that position was subsequently taken out because of a significant amount of, representations that were made by international investors and tax representatives. But as I said, the earlier tax CBDT circular of 789 was the time when this became actually an issue. But the most of the subsequent issues have been highlighted in the 2012 Act and the subsequent amendments made in 2013. So basically, I think the basic issue was, from a government's perspective, the argument was, submission of a tax return certificate is a necessary but not sufficient condition to claim the benefit. This was what they were proposed to bring it. And this is the line that was also there in the explanatory memorandum to the finance bill. But because of the representations made by a large number of investor community, and at that point of time, we also should appreciate that, India was looking at a significant amount of FDI that was coming into the country. So this was dropped. And the only issue that was, kept in the statute was to ensure that, yes, the submission of the tax return certificate should be the compulsory requirement and nothing more than that. Now, what has happened is this is being debated and discussed through a multiple cases. In fact, as late as yesterday, there was a decision by the Bombay tribunal where they have kind of confirmed that yes, if you have obtained a tax residency certificate, that should be sufficient for you to claim the treaty benefit. But I think the issue is sometimes the tax authorities try to become a little bit overzealous, and with that appreciation to try and get more tax, sometimes they go somehow overboard and they try to impose taxes on circumstances which was not supposed to be. And that is what is subsequently had to be addressed through the judicial overreach and judicial intervention. Now, why these are two different circumstances is, I think, basically, as we're trying to just clarify that, the issue in favor of TRC being a sufficient, evidence is paramount. And a number of cases, judicial precedents that we have got are actually in favor of this particular premise. And the logic for this is simple, that, once you have signed up a double taxation avoidance agreement, and once you have agreed to provide benefit to a taxpayer, subsequently you don't have the ability to go back and start challenging it. Even the judicial, even our legislative provisions are supporting this particular perspective, because if you look at 90 subsection 4 or 90A subsection 4, they are very clear that if you are obtained a tax residence certificate, that should be sufficient. This has also been highlighted by the Indian government in a couple of instances. After the circular 789, there was another circular that was issued in 2013, which kind of reconfirmed this point. Now, so these are on the left hand side, there are a few illustrative cases where they have confirmed that yes, TSC should be sufficient. However, there are also a slightly different view, again taken by the AR, in case of AB Mauritius, and also another one in relation to Big Services Division Mauritius. In both these cases, the basic argument was that when you're trying to make an investment into India, did you have that entity in place? Did that entity had sufficient money in its bank account? And whether or it was only done as an interpose just to take advantage of the treaty benefits. Now, I think if you really look into it, both these are discussing the same thing. And if you look at it at a conceptual level, both of them are actually talking in opposite lines. So it is absolutely necessary for the government to be clear that in what situations they are willing to give the tax benefit to the taxpayer, and in what situations they do not want to. Because while you can keep continuing arguing, depending on which side you are in, but at the end of the day, it is a fact that nobody wants to incorporate an entity in Mauritius or in Singapore if they don't want to take the treaty benefits, right? So if that is the basis on which the investment was planned, then what is the reason for denying that benefit to the same taxpayer at a later date? I think that's the fundamental issue. In my view, if they have already given their acceptance to the TRC as the sufficient evidence, they should continue to provide that, and we should kind of, get around these numerous tax legislations, tax litigations that we are facing through. And we should make it evidently clear that yes, under these situations, you will continue to get the benefit, and in all other situations, your position would be denied, subject to the tax authorities being in a position to come up with a with sufficient evidence to justify as to why they don't wish to give the tax benefit. Now, just to clarify, both in Blackstone as well as Serco BPO, they have granted the benefit to the taxpayer with on the premise that yes, there is a clear legal provision. On the top of it, the government of India has also clarified its position, and they have also clarified to the extent that, look, even if you have a director who is sitting, who is a director of the Mauritius entity, he should not be required to stay in Mauritius all over. He can go and come back, and so long as he's there for a reasonable amount of time, he's attending board meetings, that should be sufficient. You should not put unnecessary imposing conditions on the directors to claim the treaty benefit. And the fact that once a tax residency certificate has been issued by the Mauritius authorities or Singapore authorities, you do not have the ability to challenge that, because if you do that, then you are crossing the sovereign limits of another country by challenging a decision taken by the authorities of that country. Similarly, in Serco BPO also, they've held that the TRC is sufficient evidence, and you should be you should rely on your own CBDT circular and also the Supreme Court decisions which have given you the benefit to grant the tax benefits. Now, in this case also, it was a positive case. Now, as against that, I'm just going to go to the next one. This is where the contrary position was was held, and it was actually a decision that was given by the tribunal, or sorry, by the AR on the same day. One was positive, the other one was negative. One was positive from the perspective of India-Singapore tax treaty. The second one was negative from the perspective of India-Mauritius tax treaty. Now, it's important, and it's also relevant for us to actually get into the specific facts. Here, I think the basic issue was there was an agreement that yes, I will set up a Mauritius subsidiary. There was also an agreement that yes, the Mauritius subsidiary shall be used to invest into an Indian entity, and all of that was agreed upon even before the company was incorporated. So this is the reason why the AR decided against the company, saying that, look, you are not even in existence when the actual investment decision was planned, and once you're making the investment, then on what basis should we give you the benefit? So this is like one of those outliers, and there is this other company which is again a South African entity who was planning to bid for certain contracts in India, and they decided to set up a Mauritius subsidiary, but they were unable to come up with any cogent business rationale or to justify why they needed a Mauritius company to be interposed in between. They could have directly invested from South Africa, and they were unable to explain this, and that kind of bore in mind in the as far as the AR's members are concerned, and ultimately the benefit was denied. But I think the basic issue is in what situation this would be decided in your favor, and in what situations it would be decided against us, is something that you will have to plan it out beforehand. You will have to ensure that your conduct, your way of doing business, and your way of explaining and presenting it to the courts should be thought out well in advance, because most of the other positive cases that we talked about, and there are many more, I've just for illustrative purposes, I've only talked about only a few. But if you really look at it, there are numerous positive decisions and a very few negative decisions. But the main objective is what you need to ensure is the company that is making investment should be investing through its funds, its own funds from the bank account in that jurisdiction from where you're making the investment. You should be, there for a long period of time. It should not be like a fly-by-night operator. You should not just, infuse the money and within a few months you're taking the money out. That is something that is frowned upon. And thirdly, you should have the requisite requirement. Like, for example, in the case of Blackstone, the courts were very clear that you are not required to have a significantly large number of employees. You need not have a large office because you're an investment company. So long as your investment and divestment decisions are taken by your board, that is self-sufficient. Even if you're borrowing money, that is okay, so long as all that has happened before you are actually making the investment. And ultimately, how it is going to play out when you're presenting your case before the court would be dependent on how well you are able to explain your position. So I think that there is also a situation of what exactly who would be regarded as a Benami shareholder. I think this is again something that was decided in favor of the company here in case of MIH India, because just because you are investing through Mauritius, just because you're claiming tax treaty benefits doesn't make you a Benami shareholder. So long as you're able to explain why you have set up that entity and for what purpose you're using that entity to make investments. These are very basic stuff that you need to ensure that you should e-file. Now there is a requirement that you can actually file even a physical copy till 30th September, but post 30th September 2023, you need to electronically file your self-declaration form in 10F. Now this is over and above the TRC that is required to be submitted by you in case your TRC does not contain all the necessary information that the tax authorities require from you. Now, the payee can ask you for a copy or it can be asked by the tax department. But so long as you have already, obtained a copy and you're actually in a position to provide the same, that should be fine. And you need to do some basic level of diligence when you're investing through a vehicle, either in Mauritius or in Singapore or in Cyprus. You should be entitled to the TT benefit. But the basic issue that remains to be there is you need to have a TRC because that's a basic primary requirement. Thank you.
Thank you, Mr. Patnaik. That was excellent. Some fundamentals. Tax is important. Tax compliance is important. But all of us must appreciate that what is at stake for a nation, for its people, for its business, for its economy is not only tax. So certainty of tax laws, ease of business, for an investor knowing what he's walking into and what he will receive or not receive, this needs to be kept in mind. Finally, the economy runs on various aspects, including foreign investors. We are reading every day about the positive effect of our Prime Minister's visit to US and about how much investment is expected. There is no talk about how much tax is expected. Tax, direct, indirect will come, employment will come, technology will come, benefits will come, products and services will come, opportunities will come. So if I am overzealous, supposing I am a collector of tax, and I act in a manner contrary to the assurances given by my government, my superiors, CBDT, Finance Ministry, Supreme Court judgment, then am I really doing something in the best interest of my country? I need to think about this. Thank you, Mr. Patnaik, for your presentation. I now have Gaurav Jain, who is very kindly handling two topics. One is the mandatory requirement of DIN, be it notice, summons, communication, order, and how absence of DIN will make that communication non-est. And he will also talk about faceless appeals. Gaurav is also a chartered accountant, lawyer, more than 20 years experience. He argues in all the forums, including matters relating to tax such as BMA, PMLA, Benami, High Court, Supreme Court, and of course, he's a regular in the tribunals for many, many years. Please welcome Gaurav Jain.
Thank you, Anil sir, for the warm introduction. Good evening, friends. The topic that is given to me is DIN. DIN, as the name suggests, is document identification number. And this is a fallout of electronic communication or the conversion of electronic mode of assessment and appeals. And why this topic is important today is that we have now several decisions coming from various courts and tribunals where they have held that if a document, notice, order does not contain the DIN number, that is invalid, that's a non-est communication. And thereby, the entire notice or proceeding or the order can be considered as an invalid order. So that is the reason why today we are discussing this topic. This is important both from the tax department perspective as well as from the assessor's perspective in order to deal with their defenses when a document is found not to be with a DIN, and what are the modalities as to when a DIN can be issued or a document can be issued without DIN, and if it is issued without DIN, then what are the procedures that a department needs to follow to regularize a document issued without DIN, and if that is not followed or there is a lapse in regularization of that process, what is the fallout of that document, whether that document can still be considered as an invalid or a non-est document. So that would be the entire subject we will be discussing today. So with that, I bring your attention to this presentation. The first, as I pointed out, on the left-hand side is a sort of a document. I have reproduced over here is a notice of demand under section 156, which on top right-hand corner contains the DIN number. DIN is a 20-digit unique number, document identification number, which is generated electronically as and when a document is to be communicated by the tax department. Why did the requirement of DIN come into play? Obviously, the first requirement was that the income tax department has completely shifted to electronic mode of communication through ITBA portals and all. And secondly, there were two basic reasons which have been displayed in the press release when DIN procedure was issued. One was to maintain proper audit trail of departmental records and to bring accountability amongst income tax authorities. Accountability in the sense that there were instances where illegal communications could have been issued in the form of notices. In order to curb that, the DIN was introduced. And second, in order to maintain a proper audit trail. We see in litigation that matters become very old and assessment records are called by the courts, tribunals at a very later stage. And those documents are not available in the file of the department. So this is sort of to curb that practice, that in order to maintain a proper audit trail, because as and when a document is uploaded on the system and a DIN number is generated, that will always be available on the cloud, on the portal of the income tax department as well as the assessee. So that was the primary object, that is to maintain proper audit trail of the documents that this DIN was introduced. Now, how the DIN has evolved, just a brief overview of the statutory framework of the DIN. the DIN was first made mandatory by virtue of a statutory provision, that is section 282B, which was inserted in the Income Tax Act by the Finance Number 2 Act 2009, which provided that any communication to be issued after 1/10/2010 was to mandatorily contain a DIN number, and if that DIN number will not be there, that communication will be considered as invalid or non-est. However, then since the infrastructure was not completely available, that was partly postponed by Finance Act 2010 to notices to be issued after 1/7/2011. The infrastructure was again not complete, and therefore this section was completely repealed by Finance Act 2011. And there was no provision in the statute after 2011, and still there is no provision in the Act. There is no mandatory statutory provision in the Act which mandates income tax authorities to code DIN. Then where does this requirement come from? Friends, this comes from a CBDT circular number 19 of 2019, dated 14/8/2019, that this requirement came into play. And this came into play when ITBA portal was made effective, e-assessment schemes were made effective, and subsequently faceless assessment scheme was made effective, that this circular was issued. Now, what does this circular say? First it says why DIN has been made mandatory, because by virtue of launch of ITBA platform, enabling generation of almost all the notices, orders, or any other correspondence through ITBA platform. The circular says that instances were noticed where communications were issued manually, resulting in failure of maintenance of proper audit trail. Again, the requirement of DIN, as mentioned in the circular, is the requirement to maintain a proper audit trail. So what does the circular say? This is the finding of the circular. Circular decided that no such communication would include every notice, order, anything in the income tax statute that is to be done, shall be issued by an income tax authority on or after 1/10/2019 without mandatory allotment of computer generated DIN. So even if my assessment proceeding is initiated prior to 1/10/2019, but if any notice is to be issued after 1/10/2019, or any order pursuant to already initiated proceeding is to be passed after 1/10/2019, then it has to mandatorily contain a DIN. So it is sort of a retrospective or a retroactive kind of a requirement that any communication after 1/10/2019 has to mandatorily contain a computer generated DIN. And friends, the second requirement is issue. So every communication shall be issued. So please keep in mind the word issued. I will impress upon the importance of this word issued in my later slides. Now, the CBDT also provides certain circumstances where a communication can be issued without quoting a DIN. It's an exhaustive list as prescribed in the circular. That exhaustive list is when there is a technical difficulty in generating, allotting, quoting DIN, maybe a computer or any technical difficulty in the system, then a communication can be issued without DIN. Income tax authority, while discharging official duties outside its office, so he is not available in the office and the communication has to go, he can do it manually without issuing DIN. Delay in PAN migration, and PAN is with non-jurisdictional AO. With a jurisdictional AO, PAN has not been migrated. PAN of the assessee is not available and proceedings is to be initiated. And last, functionality to issue communication not available in the system. Maybe in a remote place in the entire country, there is some place where there is functionality is not available. So in all these situations, the circular says that a communication can be issued without DIN. But that's not end of the matter. It hedges it further by saying that while communication can be issued without DIN, but the officer has to record a reason in that communication, reason to be recorded in writing as to what was the circumstance which led to the issue of communication without DIN, and that reason has to be with prior approval of CCIT and DGIT, and the communication, the extract of the nature of reason has also been prescribed in the circular. So any communication issued without DIN shall be rendered as invalid and shall be deemed to have never been issued. So two circumstances: if you do not fall in any of the exhaustive lists, then and the communication is issued without DIN, then it becomes invalid, it becomes non-est. Or if it is issued without DIN, falling in the circumstance but it is not without a reason recorded in writing and without the prior approval of the CCIT, DGIT, then also that communication as per the circular becomes invalid or non-est. And then the CBDT circular further says that if the communication was issued without DIN in 3 categories: technical difficulty, income tax authority outside the office, or delay in PAN migration, then the officer has to take a DIN. He has to upload the DIN number within 15 days of its issuance. So that manual communication has to be regularized by obtaining a DIN within 15 working days of the date of its issuance. And then if the system, if the functionality was not there and the manual communication was done, then the AO or the officer has to intimate the DGIT systems within 7 days from the date of issue of manual communication. If that is not done, then again, that manual communication, even without a functionality, will be rendered invalid or non-est. So this is what the sum and substance of the circular is. So in order to sum up, the circular says mandatory quoting of DIN at the time of issuance of any communication. So as and when the communication is issued, it has to mandatorily contain a DIN. If it is issued manually in circumstances, then the reason has to be recorded in writing with prior approval of CCIT, DGIT, and within 15 days, that manual communication has to be regularized by obtaining a DIN. Now, friends, what issues arise from this circular? The first 2 issues that arise from this circular is that the requirement of DIN is not statutorily contained. Unlike section 282B, as on date, there is no section. 282B was repealed in 2011. So the only mandate is by way of a CBDT circular. So whether by way of a CBDT circular, can the assessee argue that a communication is non-est, an order is invalid, or a notice issued, a jurisdictional notice issued is invalid? That's the first question that comes up. Second is we have section 292B in the Income Tax Act, which says that if there is any mistake in any communication and in sum and substance, when the communication is done with the right intent, then that mistake is condonable under section 292B of the Act. So the issue arises whether in such situations where reason is not recorded and a manual communication is done, whether department can argue that it's only a mistake, it's a trivial mistake of non obtaining a DIN, and therefore the communication cannot be considered as invalid or non-est. These 2 questions have been recently answered. There were several decisions of tribunal, but a landmark decision of Delhi High Court in the case of Brandix, where these 2 questions have been answered. The Delhi High Court has conclusively held that CBDT circular, being a beneficial circular, is binding on tax officers, and therefore tax officers cannot argue that since this requirement is only by way of a circular, it is not binding. It's a binding requirement. And if the circular says that the communication without DIN is non-est, invalid, then it is invalid, it is non-est. And therefore, in this case, the assessment order which was passed under section 147 without obtaining a DIN was held to be an invalid order, non-est order. The order was quashed by the Delhi High Court. The Delhi High Court also dealt with the provision of section 292B. They said that the requirement of DIN by virtue of the circular is a jurisdictional requirement. It is not a trivial mistake committed by the assessing officer. It would defeat, if we would consider it to be a mistake, it would defeat the purpose behind the entire e-scheme and the requirement of the CBDT to introduce the DIN requirement, and therefore it cannot be precluded under section 292B of the Act. So both the issues were answered in positive by the Delhi High Court in this decision, and the assessment order which was quashed by the ITAT was upheld by the Delhi High Court. And then there are other decisions of tribunal prior to this decision of Delhi High Court which had taken the similar view that the CBDT circular is binding and the order without DIN is an invalid or non-est order. Now, friends, the second issue that arises is, as I had pointed out, the circular says that communication has to be issued without DIN. Now, there could be a situation that an order is to be passed within a limitation period. An order is passed by the AO, but DIN was not obtained on that date. On the date of passing, let us say the limitation is 31st December 2022, and the order was passed, but DIN was not obtained. DIN was obtained on 1/1/2023, and that order was communicated or issued to the assessee. Now, the requirement in law is that order has to be passed in within time limits that is met by virtue of order being passed on 31st December in this illustration. Now, the question arises whether DIN has to be obtained at the time of passing the order or at the time of issue. As I pointed out, the circular says that the communication DIN has to be obtained at the time of issue, at the time when a relevant notice order is communicated to the assessee. So in this illustration, since at the time of communication to the assessee on 1st January, DIN is obtained, the DIN is valid, the order is valid, order cannot be said to be an invalid or a non-est order. So what we have to keep in mind is the distinction between making, issue and communication. So the requirement of DIN is only at the time of communication, not at the time of generating of the notice or at the time of passing of the order. So several situations of this distinction between issue, service, passing can come up, which I have discussed with a sort of an illustration. And this illustration is even discussed in a decision of a Jharkhand High Court in the case of Prakash Lal Khandelwal, where exactly similar kind of situation arose. And the assessee argued that since at the time of passing the order, DIN was not obtained, that order is invalid, which was decided against the assessee. The High Court said that no, the requirement in circular is that when the order is communicated, DIN has to be generated at that point of time. In the instant case, since the order was issued, maybe 3 days later, the passing, but at the time of issue, the DIN was obtained, the order is valid. The order cannot be invalidated because at the time of issue of the order, the DIN was obtained. Contrast to this decision of Jharkhand High Court, we have a latest decision of Delhi Tribunal in Pratap Singh Yadav. In this case, the order was passed on 24/12/2021 without issuing DIN and was communicated to the assessee on the same day. And the subsequent DIN was obtained subsequently on 3rd February 2022 after 2 months delay. The department argued that since the order has been regularized, although after a period of 2 months, the DIN has been obtained and therefore the assessment order cannot be held to be invalid or non-est. The tribunal followed the circular in its true spirit and held that what the circular requires, order is to be issued with the DIN. The order was issued on 24/12/2021 when DIN was not obtained and therefore the order is invalid. The order was passed without obtaining any reason, no reason was recorded at the time of issue of manual assessment order and without obtaining any approval of the senior authorities. And therefore, since there was no compliance of the circular, it was not regularized within a period of 15 days, the order was held to be invalid. Friends, then again, the issue would arise whether such kind of issue can be validated under 292BB. There is another provision in the Income Tax Act 292BB, which says that if the objection is not raised with respect to service of the notice, then that objection cannot be raised at a later stage. So suppose a notice or a communication was issued without DIN and I failed to take that objection at the time of assessment, and now I want to take it in my pending appeal. Can I be precluded by section 292BB? The answer to my mind is no. I don't have any direct decision on this point. But according to me, 292BB does not prevent issue. It is only applicable to service of a notice, whether the notice has been served on time. And therefore, since this is a requirement of issue, which is a jurisdictional requirement, 292BB will not come into play. Then another issue is assessment order is passed with DIN, but notice of demand under section 156 is without DIN, or a computation of demand is without DIN. Now, circular says that every communication has to be with DIN, and the Supreme Court says that notice of demand is integral part of the assessment order, which needs to be issued along with the assessment order. So while assessment order contains DIN, but notice of demand does not contain DIN, the question arises whether that assessment order can be said to be invalid. I think there is a possible argument, but it's an open question, just a food for thought for the audience today. Then friends, the another issue arises is whether DIN has to be quoted in the body of the relevant communication assessment order, or it can be stated in the supplementary letter. So we have a decision from a Bangalore bench of tribunal which says that no, it has to be issued in the body of the order. And if you are not quoting DIN on the body of the order, there has to be a reason recorded with prior approval of DG. And then within 15 days only you can issue a supplementary letter. But if you do not quote the DIN in the body of the order, you do not give the reason in the body of the order, the supplementary intimation quoting the DIN will not save you, will not protect you. So friends, these were the various situations. You can see the length and breadth of the small issue of quoting DIN, which can come to the rescue of assessees in the prolonged litigation. So this is what I wanted to discuss about DIN. Over to you, sir.
Thank you, Gaurav. Clearly, it's a deeply thought out and presented presentation. Thank you very much. You are also covering faceless appeals. It is more procedural.
Yes.
There is less of law, though everything has law in it. We are past our time, and I deeply appreciate your cooperation. So in whatever briefest, you could just touch the fundamentals and basics.
Yes, sure. So I think faceless appeals, it does not have much of law, but yes, it is a sequitur to the faceless assessment since the government had already made assessments faceless. The faceless appeal was an automatic sequitur to follow since CIT appeals are part of income tax department. And the change that has come in with faceless appeals is that now there is no physical hearing. Whatever has to happen is through the faceless appeal center, akin to faceless assessment, where every communication with the tax officers is happening through faceless assessment center. In case of faceless appeals, that communication is through faceless appeal center. So on the ITBA portal, if I have to receive notice of hearing, it is through faceless appeal center. If I have to file my submissions, it is through faceless appeal center. If I have to file an additional ground of appeal, additional evidence application, condonation or delay application, that is through faceless appeal center. Now, faceless appeal center forwards it to the relevant, if there is an automated allocation system where the appeals are allocated randomly to CIT appeals across India. CIT appeal also cannot communicate directly with the assessees or with the assessing officers. They have to communicate through the National Faceless Appeal Center. Now, there could be situations like of additional ground of appeal, additional evidence, or further investigations. All that has to happen through the National Faceless Appeal Center only. So if the appellate authority is to send the additional evidences to the assessing officer, he has to send it to the National Faceless Appeal Center, who would further forward it either to the jurisdictional assessing officer or to the National Faceless Assessment Center. So this is basically broadly what has happened in the regime of conversion from physical hearings to faceless appeals. It was a welcome move. We were thinking insofar as we professionals are concerned, faceless, it was some sort of a boon because it saves a lot of time. It saves time for waiting for hearings in the officers of CIT appeal, etc. But when we see it practically, it has not achieved that result. While there is disposal of appeals involving small or straight issues, but on the ground what is seen is that the complicated or large issues have not seen light at the end of the tunnel. There is no disposal on those complicated matters, and the reason for that is possibly that even the officers sitting behind the screen need assistance of the assessees, need the assistance of the counsel, which possibly with this faceless appeal is missing. And therefore, we have not seen success so far. There are a lot of pending appeals at the end of faceless appeal centers, and we yet to see whether there could be any change in this scheme. The other short point which has recently emanated in the faceless appeals is the emanation of JCIT appeals. So the Finance Act 2020-23 has introduced a new section or revamped an old section 246 into a new 246, which they have given powers to joint commissioners to be joint commissioner appeals. The scope of appeals is almost similar to what is there for earlier CIT appeals. It is almost same kind of orders can be appealed before JC appeals. Only the orders should be passed by officers below the rank of JC appeals, that is by ACIT, DCIT, and there are certain exceptions like search orders or international tax orders. They cannot be filed by way of appeal before JC appeals. Now that provision is supplemented with a faceless appeal scheme and a notification issued by the CBDT. The sum and substance of that notification is that only old appeals, old assessment orders which were not passed in the e-assessment or faceless assessment regime prior to 13 August 2020 involving tax demand of less than 10 lakhs are to be, as on today, are to be decided by JC appeals. So orders passed by officers below the rank of JCs, orders other than search assessments, or the orders other than international tax orders, and having tax demand of less than 10 lakhs. And tax demand would mean tax, interest, surcharge, education cess. If that is less than 10 lakhs, only those appeals are to be, as on date, allocated to be JC appeals. This is again a welcome move. They are increasing the strength of the officers to dispose the appeals. According to me, the limit given to the JC appeals of 10 lakhs is little less. But if we see success in this appeal, maybe in times to come, we can have more appeals by JC appeals. Over to you, sir. Thank you.
Thank you, Gaurav, and thank you for keeping it brief. I request my co-chair, Pallavi Dinodia Gupta, to please give the vote of thanks. And Monica, you may wish to coordinate the presentation.
Yeah, thank you, sir. Now, before we give the formal vote of thanks, as a token of appreciation to our guest speakers, I'll request Mr. Anil Chopra to present a plant to Ms. Gauri Puri.
एक दो क्वेश्चन हो सकते हैं क्या?
Sir, once we do this ceremony and then perhaps, ma'am, you can take 2 or 3 questions. I'll request sir to give a plant to Mr. S.R. Patnaik. Sir, please present a plant to Mr. Harpreet Ajmani as well. Thank you, sir. May I now request Ms. Pallavi Dinodia Gupta, co-chair of Direct Taxes Committee, to present a plant to Mr. Rohit Jain. Thank you, ma'am. Now I'll request you to present a plant to Mr. Gaurav Jain. Mr. Gaurav Jain is the knowledge partner to the event as well. So a big thank you to you, sir. Now I'll hand over to Ms. Pallavi Dinodia Gupta, co-chair of Direct Taxes Committee, to give the formal vote of thanks. Ma'am, you can take 1 or 2 questions as well.
Sure, Monica. Thank you. Okay, being cognizant of time, maybe we can do 2 questions. So you had a question?
Madam, I am Rupinder Singh. I am technology expert. Madam, in the case of Reliance Petroleum, you know, Reliance Petroleum is exporting diesel at say 50 rupees per liter. But Indian Oil or PSUs are importing oil at say 40 rupees per liter. How do you explain this, you know, situation?
Sir, I'm not sure it has a tax question in it.
No, tax avoidance, you know, underreporting. The first
And
chapter was
misreporting. Okay.
underreporting issue, you know.
We don't-
Underreporting.
Yeah, we will not like to go into specific cases. Yeah, thank you. Yeah.
Okay, thank you.
Okay. I think if you permit me, I would be very happy to listen to you, but we are way beyond time and I need to close, please.
Leave it.
Because
Okay,
the
thank you.
chamber people also, you know, they need to close office.
Very right.
But it's
Thank you.
you've been very kind and very patient and
we
we,
can ask him.
you can, there's
During
tea,
the time you can raise the
there
question,
is
yeah.
tea after this,
Yes,
please,
very right.
please, free to ask. You're most-
Networking and the question.
Okay, go ahead, quickly, but please, you know, if I let you, then why not B, why not C, but go ahead. Oh, no, go ahead, quickly, ab kar rahe hain to kar lo. हाँ.
Gaurav ji, excellent insights into both your topics, and my only question is, in case of an assessee who is not an eligible assessee under the faceless scheme, the AO-NAFC does not share the draft assessment order with the assessee and just straight away issues the final assessment order under section 143(3) and 144, read with 144B. Is there any case on this?
No, but I don't remember the case, but if it's not an eligible assessee, then it will not be covered by 144B. And if it is not covered by 144B, then there is no concept of draft assessment order. Then there is no requirement of draft assessment order. Yes, he will have to follow the principles of natural justice. He will have to issue you a show cause notice. And if he passes the order without show cause notice, that can be a ground, but not a ground of draft assessment order.
Thank you. Thank you very much.
Thank you.
So shall I? So I'll close this with a formal vote of thanks. Thank you to all the panelists today to take out their valuable time to be with us here at the PhD chambers. Thank you to the audience for a very patient hearing. I think, like Anil sir said, we've covered from time immemorial of reassessment, maybe before I was born, to today where DIN and faceless schemes, are the order of the hour. So I think that the whole gamut of tax issues remains the same. So I hope that you enjoyed our session today. Thank you so much for being with us.
I request you all to join us for high tea. Thank you.